You checked your credit score this week. Maybe you check it every week. And when the number was good, when it held steady or ticked up a few points, you felt something. Not quite pride, but adjacent to it, like a grade came back and you passed. Like the system looked at your financial behavior and said, acceptable. And you carried that number around like a quiet credential, like proof that you're doing something right. But nobody ever told you who that number is actually for. Let's go back to when you first learned the score mattered. You were probably young. Someone told you to build credit. Get a card, use it a little, pay it off. Keep the balance low. Don't close old accounts. Don't apply for too much at once. The rules were specific and the stakes felt clear. Good score meant good rates. Good rates meant cheaper borrowing. Cheaper borrowing meant more access, and access, you were told, was opportunity. So you followed the rules, you optimized the number. You became, over years of careful behavior, a person with an excellent credit score. And somewhere in the process of optimizing for that number, you started making financial decisions based on what was good for the score rather than what was good for you. Think about the last time you kept a credit card open that you don't use. Not because you needed it, not because it gave you anything, but because closing it would affect your credit utilization ratio and drop the score. You've been carrying dead plastic in your wallet or a dormant account in your credit file for years because the algorithm that measures your financial health told you that account's existence makes you look better. And you listened because the score is the thing you're optimizing for, and you've been doing it for so long that the optimization feels like strategy. Or think about the last time someone asked what your credit score was. Maybe it was a landlord, maybe it was a lender. And you told them and you noticed how the number positioned you. A score above 750 and something changes in the conversation. The rate gets better, the approval comes faster. And that experience, being rewarded by the system for having a high number, reinforces the belief that the number is the goal. That a higher score means you're winning. But here's what winning actually looks like for the people who designed this system. You spend more, you borrow more, you keep more accounts open. You maintain relationships with more financial products. You carry small balances because that's what the algorithm rewards. Utilization above 0, but below 30% means you're an active, manageable borrower. You're not paying it off completely and you're not maxing it out. You're in the sweet spot. The sweet spot where interest accrues just enough. Where you're just engaged enough with debt that the financial system continues to profit from your responsible behavior. Your excellent credit score is a loyalty program for borrowing. And you've been a platinum member, and this is where it gets interesting. Because most people, if you ask them what their credit score was for, would say something like, so I can get good rates when I need to borrow, and that's true as far as it goes. Low rates on mortgages are real. Low rates on car loans are real. The difference between a 620 and a 780 on a 30-year mortgage can be tens of thousands of dollars, and that difference is worth caring about. But here's the part that never gets examined. The entire value proposition of a high credit score is predicated on the assumption that you will be borrowing. That borrowing is a permanent feature of your financial life that you should optimize around. That the most important thing to do with good financial behavior is make yourself a more attractive borrower for the next loan. What if the goal was to need fewer loans? Nobody asks that question in the credit score conversation. Nobody says, the person with the highest credit score and the fewest debts and the most assets is not the person who optimized the score. It's the person who built enough wealth that the score stopped mattering. Because a credit score is irrelevant to a person whose financial decisions don't require debt. And the entire system, the monitoring, the optimization, the careful management of utilization ratios and account age and hard inquiries exists to make you a better participant in a debt-based financial system. Not a wealthier person, a better borrower. Those are not the same thing. Nobody taught you this. You were handed a metric and told to improve it, and the metric was designed by the people who profit from what it measures. You were too busy building the score to ask what you were building it for. But here's what nobody tells you about money. The credit score is one of the most successful pieces of financial misdirection in modern history. Not because the number is meaningless, it has real effects in real situations, but because of what optimizing for it teaches you to value. It teaches you to value access to credit over freedom from credit. It teaches you to measure financial health by how attractive you are to lenders rather than by how much you actually own. It creates a framework where the person with $0 in assets and an 800 credit score looks, by this measure, more financially successful than a person with $400,000 in invested assets and a 680 score because they don't borrow enough to maintain excellent credit. That inversion, let it land for a second. The credit score does not measure wealth. It does not measure savings rate. It does not measure net worth. It does not measure financial resilience. It measures your relationship with debt. Specifically, it measures how reliably you service debt, how long you've been doing it, how diversified your debt types are, and how much of your available credit you're using at any given time. Every component of the score is about debt. And a system that measures only your debt behavior and calls it financial health is a system designed by creditors, for creditors, to identify and reward their best customers. You are being scored as a customer, not as a wealth builder. The wealthy don't think about credit scores the way you were taught to think about them. The people who build real wealth think about credit as a tool with a narrow, specific use case, primarily the mortgage. Because a mortgage is the one form of borrowing where the asset you're purchasing typically appreciates, the loan term is long enough that rate differences compound meaningfully, and the scale of the transaction makes even a half-point rate difference worth significant optimization. For that specific use case, yes, the credit score matters. Have the high score when you're getting the mortgage, then stop optimizing. Because once the mortgage is in place, every dollar and every hour you spend managing your credit score for any other purpose is a dollar and are not building the actual thing you're trying to build. Let me tell you about a woman named Claire. Claire is 37. She has an 812 credit score. She monitors it weekly. She has 6 credit cards, 3 she uses regularly, 3 she keeps open solely for utilization and account age. She knows her average account age to the month. She knows the optimal utilization percentage. She is excellent at managing credit. She has $18,000 in a savings account, $34,000 in a 401k she hasn't increased contributions to in for years, and $9,000 in credit card debt she rotates carefully to keep the score high while managing the balances. Claire is a masterclass in credit score optimization. Claire's net worth, at 37, is approximately $43,000. Claire has spent 15 years becoming an expert in something that served her creditors more than it served her. She is not an outlier. She is the design working as intended. But there's something darker underneath this. Here's the first principle. The credit score is a measurement of your value to the lending industry, and you've been managing your finances to improve it. The common belief is that your credit score is a measure of your financial health. This belief is so widely held, so embedded in how financial institutions communicate, that questioning it feels almost paranoid. The score is how your bank evaluates you. It's how landlords evaluate you. It's how insurance companies set your rates in some states. It's treated as a universal indicator of how well you manage money. But it's not. It's an indicator of how well you manage debt. A person who has never borrowed money in their life has no credit score at all. Not a bad one, none, because the score requires credit history to exist. And a person with no credit history is, by this system's logic, invisible, not wealthy. Not responsible, invisible, because they have nothing for the system to measure. That tells you exactly who the system was built for. The identity shift is from I need a high credit score to I need a high net worth, and I will have the credit score I need for the specific moments when borrowing is strategic. Those are different relationships with the number. The first person manages their finances around the score. The second person manages the score around their finances. The first person is the customer. The second person is the user. And what happens next is the part most people miss. Here's the second principle. Credit card rewards are the most sophisticated wealth transfer in consumer finance. You know about rewards. You probably have a rewards card or two. And if you pay them off every month, you feel like you're winning, getting the points, the cash back, the airline miles, while the bank gets nothing because you don't pay interest. You feel like you found the loophole. Free money from the credit card company, and in a narrow sense, for a specific type of person, that's partially true. But here's the fuller picture. The rewards don't come from nowhere. They come from two sources: the interchange fees that merchants pay on every transaction, which get baked into the price of everything you buy, meaning you pay for the rewards system even when you use cash or debit, and the interest and fees paid by the people who don't pay off their balances every month, who are disproportionately lower income, who fund the reward programs that higher income cardholders then collect. The reward system is a wealth transfer from people who can least afford it to people who can. And your participation in it, even as a responsible user, is part of the machinery. This is not an argument to stop using rewards cards if you pay them off monthly. It's an argument to see the system clearly. Because the same intelligence you're using to optimize your rewards and manage your utilization could be pointed at your investment account, your income, your business, your skill development. The mental bandwidth you spend managing financial products designed by billion-dollar companies to extract value from their users is bandwidth not spent building something of your own. This is where it gets interesting. Here's the third principle. The number you should be optimizing is not your credit score. It's your investment account balance, your savings rate, your net worth trajectory. Those numbers don't send you weekly updates. No app gamifies them with color-coded trends and celebratory notifications when you hit a new high. No landlord asks for your net worth statement before approving your application. No lender rewards you for a high savings rate. The financial system has made the credit score visible, trackable, and emotionally rewarding to improve because improving it makes you a better customer. The numbers that actually determine the quality of your future, savings rate, investment returns, net worth growth, those are invisible unless you make them visible yourself. Think about how much mental energy you've spent on the credit score, the monitoring, the optimization. The anxiety when something unexpected hit your report, the relief when it recovered. Now imagine that same energy directed at your investment account, at your savings rate, at the gap between what you earn and what you keep. The people who retire with options, who have choices in their 50s and 60s that most people don't have, are not the people who had the best credit scores. They are the people who pointed their financial attention at the right numbers. The numbers that compound, the numbers that grow, the numbers that represent ownership rather than access. Access is the credit score's promise. Ownership is what the credit score can never give you. Here's the uncomfortable truth. You have been trained carefully, systematically, by people with a financial interest in your behavior to measure your financial health by how attractive you are as a borrower. And you've been so successful at that optimization that it feels like success. The high score feels like winning. And while you've been winning that game, the other game, the one where net worth grows and debt shrinks and the options available to your future self expand, has been running without you paying it the same attention. Every month you spend more energy monitoring your credit score than your investment returns is a month where you are working harder for the system than the system is working for you. The credit score is a tool. It has one good use case: getting a low-rate mortgage on a property you've analyzed as a sound decision. Outside of that use case, it is a distraction dressed up as a metric, pointing your attention toward debt management and away from wealth accumulation. Project it forward. The version of you at 55 who spent the last 15 years optimizing their credit score and moderately saving has a great score and a modest portfolio. The version of you who spent those same 15 years aggressively building net worth, saving first, investing consistently, using credit as a tool for a single purpose rather than a lifestyle to maintain, that version has options. Not marginally more options, fundamentally different options. The ability to work because you want to rather than because you have to. The ability to make decisions from abundance rather than from access. 5 years from now, the credit score will be whatever it is. The question is what the number next to it, the net worth, the portfolio balance, the savings rate, will say. And that number doesn't improve by accident. It improves by replacing the wrong target with the right one. So here's where you are. Two paths, and the uncomfortable one isn't the dramatic one. It's the quiet reorientation of what you're actually trying to build. The first path is continuation. You keep the score high. You keep the cards optimized. You keep the utilization in the sweet spot and the account age growing and the monitoring steady. The anxiety about the number stays manageable. The number stays high. And the number that actually determines your future, the one representing what you own, not what you can borrow, grows slowly, inconsistently, whenever there's something left over after the life you've been living. Which is not often enough to change the trajectory. The second path requires you to make the number visible. Not the credit score, the net worth, the savings rate. The gap between what you earn and what you keep, tracked with the same attention you give the score that tells you how good a borrower you are. It requires deciding that the goal is ownership, not access. That the number to optimize is the one that represents your freedom, not your attractiveness to lenders. And it requires being willing to let the credit score be good enough, not perfect, just adequate for the one purpose it actually serves, while everything else you have gets pointed at the thing that actually changes your life. The question is which number you've been managing your financial life to improve. And whether that number is the right one, that's all that's left to figure out.